Hello and welcome. Thank you for joining us on Business Incorporated on Channels Television. I'm Chimeze Obi Iwago. On the program today, Moody's says African banks' credit profile has weakened from coronavirus-driven pressure on sovereigns. Egypt surprises market with first rate cut since March this year. And Ugandan government issues new land guidelines for investors. But we'll begin with intraday market numbers, and it was looking like a mixed day for the markets in Africa, especially in Nigeria and South Africa. At intraday, the NSE index was up 0.60%, while the JSE index in South Africa was down by a whopping 1.99%. Meanwhile, the market in Egypt is closed today but ended negative on Thursday. Kenya closed positive on Thursday by 0.06%. And markets in the Middle East are closed on Friday as their weekend started on Thursday as well. On the last trading day for the week, major stock markets were in the negative territory except the Qatari index, which rose marginally by 0.01%. Saudi Arabia's main index declined 0.10%. Elsewhere in the region, Dubai's main index shaved off 1.45%, while the Abu Dhabi index lost 0.52%. And in Europe, stocks were mixed on Friday morning as investors continue to monitor coronavirus developments and the prospects of economic recovery. Well, Chelsea has the details. Hello, Chelsea. Good afternoon. European stocks are on for their worst week since June as concerns mount about the economy and coronavirus. How do traders in Frankfurt feel about the outlook?
Well, these concerns that we've been discussing really all week are getting more and more real for investors. As you can see behind me, the DAX has really just been declining all day. Now it's down about 1.6%. So for investors, they really are having to face the reality that there is a second wave of coronavirus in Europe, and we are seeing more and more restrictions every day on daily life. So here in Europe, we heard earlier that Spain is going to be locking down more of Madrid. So now more than 1 million people are going to be locked down in Madrid. And the government is saying that really it doesn't even go far enough. They need more restrictions in place. We've also heard politicians here in Germany discussing potential new restrictions on daily life here, including a potential ban on alcohol in Berlin. So these are really starting to sink in for the global investment community, that this sort of easy period over the summer that we'd had where people were starting to travel again, people were going back into work. All of that is really being thrown into question now as we do see countries posting their highest coronavirus cases either in months or new records for many countries. And on top of that, you also have the continued uncertainty over the United States, including the U.S. election and the prospect for more stimulus to offset the impacts of coronavirus there. So it's really a lot of concern here at the end of the week.
And the German Stock Exchange has a new member today. The defense supplier Hensoldt went public in Frankfurt. How is its first day of trading going?
It definitely wasn't a great day to be going public. As I mentioned, the DAX here in Frankfurt is already fallen quite a bit. Hensoldt, which did debut at about 12 euros a share, has fallen quite a bit throughout the day. At one point, it was down more than 10% to around 10 euros. It's come back a little bit, but is still down almost 10%. So not the best day for this company. Whether this really reflects the reality, we'll have to wait and see. The company makes defense items, so it makes things like radars for tanks. It makes drones, cameras that can be used for things like surveillance. So their business hasn't been terribly impacted by coronavirus, but clearly not the best day to be having an IPO here in Frankfurt.
And the founder of Spotify says he plans to invest about €1 billion into European tech startups over the next decade to help the bloc catch up with Silicon Valley. Why is Europe lagging so far behind other countries?
So this has been a theme for many years now, and Europe really hasn't caught up at all. Europe, it's a little bit difficult to say if this is the chicken or the egg problem. Europe hasn't had as many big tech successes like Facebook or Google. So it hasn't had as much tech investment at the same time. So whether we don't have the success because we don't have the investment, whether we don't have the investment because we don't have the success, it's a little bit of both, I'd say. The other reasons are that governments haven't invested as much into venture capital as they have in say, the United States or in Asia, where they also have been booming. And there's also just not as many options for tech startups here. The system is much more fragmented. So really what we see is just a big underinvestment in startups, especially once they get off the ground a little bit. So if you look at some of the numbers, the United States, for example, has about $140 billion worth of investment in venture capital in 2018, and Europe only had about $23 billion. So much lower here, and that obviously does have an impact on how big these startups can grow. The founder of Spotify, his investment is obviously quite small in the scheme of things, 1 billion euros over the course of 10 years. But he is looking particularly at things like machine learning, natural sciences, biotech. Those are areas that he thinks that this money could be particularly useful, and for some companies, this could obviously be a big game changer for them.
Well, thank you very much, Chelsea. It's been a wonderful week with you, and we look forward to a pretty good conversation with you again next week. Enjoy the rest of the weekend. And Britain's economy has suffered a double blow from the COVID-19 pandemic. This morning, government borrowing has surged again, and car production has almost halved. Let's see how the markets are reading those data this intraday. Juliana joins us now. Good afternoon, Juliana. Well, Britain woke up today with a higher debt profile. You discussed this with BC in the morning, but how are the markets reading the data?
Well, it's not great, Chimase. The all-share has slipped into the red. The FTSE all-share is down 0.47%. The FTSE 100 is down 0.62%, and the FTSE 250 is down by 0.15%. On the currencies market, the pound is down on the dollar by 0.24%. Down on the euro by 0.04% and down on the Japanese yen by 0.19%. As you said, yes, we did wake up to the news that government debt is totaling £2 trillion. That's more than our economic output. No surprises there, really, because we know that we have ramped up the spending. The shopping list is getting longer and longer, especially this new job support scheme, which was announced yesterday and is likely to cost the government about £3 billion. They spent £500 million during the month of August in the Eat Out to Help Out scheme, and there are several other billions that the government has been spending. They said that they are going to spend first and think about it later, and that's exactly what's happening. So no major moves on the market when that was announced. It's worth mentioning the usual suspects who are dragging down the index at intraday. British Airways owner IAG, their shares are down 5.8%. The aerospace engineer Rolls-Royce, they're down 4.2%, and the Intercontinental Group, the hotel chain, they're down 3.2% at intraday.
And still on data, what are people driving as UK car production slumps?
Well, yeah, people are driving, but people are just not in a rush to drive new cars. No surprises there, because people in this country are concerned about their wages in the next couple of months. In fact, it's not just here in Britain. Global car demand production has fallen dramatically. But here in the month of August, car production almost halved. It was down by 42% year on year. They produced 51,039 cars. This time last year, they produced 92,153 cars. The car industry has really suffered in the UK because of the pandemic. They've lost £9.5 billion, and the job losses have reached 13,000 and are likely to mount when the furlough scheme comes to an end at the end of next month.
And looking at the week, aside from those data, what was most striking for the markets this week, and what is next week looking like?
Well, next week is the start of a new month, so we'll be expecting some September data, or at least some snapshots from September, and also August GDP figures for the UK, which are going to be highly anticipated. More Brexit negotiation talks, of course. But if we're talking about this week, there's only one story, really, and that's the UK lockdown, isn't it? There were suggestions and whispers that it was going to come, highly speculated on the markets. On Monday, 52 billion was wiped off the FTSE 100. And then Prime Minister Boris Johnson did make those startling announcements that there will be restrictions in place in the UK for 6 months. And this is really crippling the hospitality industry, particularly the nighttime economy. We've had a lot of nighttime ministers or spokespeople speaking, doing the rounds on media here in Britain, just saying just how awful it is. A lot of people are talking about pubs, bars and restaurants. Nobody really is talking about nightclubs. Nightclubs, of course, have been shut since the 23rd of March. They haven't been open, and they're not going to be opening for another 6 months. So that's 1 year of losses for nightclub owners. So that's a major story. And of course, I think next week we are going to be taking a look at the data. I believe there was some data released just before I got on air from the Office for National Statistics, which shows that 10,000 people a day here in the UK are tested positive for COVID-19. Now, the Office for National Statistics really is the data that a lot of economists and observers look at rather than the government's own official data, which does show that the virus is actually spreading much faster than had previously been thought. So, will the UK go into a full second national lockdown? Who knows? A week is a long time in COVID 2020. So perhaps this time next week, we'll be talking about a second lockdown in Britain.
And aside from that, while we wait to chew on those data expected next week, let's enjoy the weekend. I guess it's time to say, thank God it's Friday.
Thank God it's Friday.
All right, Hong Kong listed shares of China Evergrande Group plunged in a mixed trading day for Asia Pacific markets on Friday. By the Friday market close in Hong Kong, shares of China Evergrande Group listed in the city fell 9.46%. The move came after reports the property developer is seeking government support to approve a restructuring plan and warned of an impending cash crunch. Hong Kong's Hang Seng Index was down 0.32%. Mainland Chinese stocks were also lower on the day, with the Shanghai Composite down 0.12%, while the Shenzhen component was below the flat line. Meanwhile, stocks of major Australian banks jumped on Friday. Shares of the big four banks helped lift the broader S&P ASX 200 index higher by 1.51%. In Japan, the Nikkei 225 rose 0.51%, while the Topix index added 0.48%. South Korea's Kospi also advanced 0.27%. And U.S. stock futures rose slightly on Friday morning, as the market indices tried to avoid a fourth consecutive week of losses. Futures for the Dow Jones Industrial Average, they seem to be red, pointing 86 points down. And, of course, the Nasdaq Composite and the S&P are also mildly on the negative side. The move in futures comes after three major U.S. indices held on to slight gains during a choppy session on Thursday, but were still negative for the week. The state of the economic recovery has become a hot topic in recent weeks on Wall Street, especially after the death of Supreme Court Justice led many strategists to downgrade the chances for another relief package before the election. On Thursday, Goldman Sachs cut its fourth quarter projection for gross domestic product growth to 3% on an annualized basis, down from 6%. And away from those markets there, here on the African continent, rising pressure on African governments from the coronavirus pandemic is weighing on their country's domestic banks, as the creditworthiness of the banks is inextricably linked to the financial strength of the governments. This is according to rating agency Moody's. In a report published yesterday, Moody's says about 90% of bank rating actions in Africa over the past 6 months have followed a sovereign rating action. According to the report, as the government credit profiles weaken, so does their capacity to provide support to troubled banks. A senior vice president and African banking expert at Moody's, Constantino Queiroz, says past incidents of sovereign crisis and defaults also suggest that there remains a heightened risk of authorities imposing prolonged capital controls on banks during difficult times, such as restricted deposits withdrawals or forced deposit conversions into local currency. He says governments have also previously restricted foreign exchange transfers abroad, which interfere with private sector issuers' abilities to service their foreign currency debts. Right, we'll take a break, and when we come back, we'll look at the commodities market as well as all the stories. To stay with us. On domestic commodities market, we are looking at hides and skin. Hides and skins have traditionally been a source of export earnings for Nigeria. At its peak, the dollar value of the hides and skins exports was approximately $600 million, competing fairly with cocoa as a leading source of Nigeria's non-oil exports. Ironically, Nigeria has now moved from a net exporter to a net importer of leather goods. Why is that so? Oreofe Bajomo, one of the research analysts at financial derivatives company, will tell us. Good afternoon, Oreofe. Thank you very much for joining us on the program.
Thank you for having me.
So what is responsible for the sharp fall in Nigeria's leather output despite its potentials in hides and skin?
So leather is a byproduct of hides and skins, which is used to produce things like bags, shoes, belts, and other clothing accessories. The production of these resources is mostly done in the northern part of Nigeria. This part of Nigeria is plagued with a level of insecurity that has led to the destruction of wildlife and the death of farmers. As a result, this has led to the drop in output of the leather industry. Some other factors that have played a part in the drop in the output for the leather industry include unfavorable government policies, the low support from the government, the use of mundane and old methods of production, the low level of skill, as many are unaware of the growing potential of the leather industry, the drop in quality of hides and skins as there is poor husbandry, animal husbandry and healthcare, the degradation of the local value chain due to majority of the locally produced leather products being exported instead of being satisfied in the domestic market, and the high consumption of hides and skins for food, as many of these producers and suppliers gain from the food market more than the tanning industry.
Now, the green peace movement and other environmentalists have increased the pressure on exporters of hides and skins in respect to its cruelty against animal agenda. What effect will the activities of these groups have on Nigeria's potential of increasing its production and export of leather goods?
So these environmentalists would hinder the growth of the leather industry unless these companies strike a balance between profits and animal preservation. That is, maximizing their profits while minimizing the negative environmental impact that they have. Some of the ways they could do this would be to segregate a considerably large portion of wildlife for non-commercial use, allowing the ecosystem to function effectively. Another would be to take lessons from China that have adopted sound sewage treatment systems to reduce COD emissions. There is also the treatment of leather byproducts from the tanning process and the recycling of old leather and discarded leather, which will reduce pollution. As a result, it would curb the fears that environmentalists have and limit their impact in the profitability of the leather industry.
Now, none of the leading global leather goods companies like Fendi, Chanel, Gucci, Prada, and Louis Vuitton has a presence in Nigeria. Is there a possibility that any of these luxury goods companies will come to West Africa and in particular Nigeria? If so, what will be the impact on the Nigerian economy?
So yes, there is a possibility, as Nigeria has the largest resource of goats and kid skins in Africa, representing 40% in West Africa and 10% to 14% in the whole of Africa. However, the challenges, like I listed before, would hinder these companies from setting up in Nigeria unless solutions are provided, like increased access to credit facilities, modern technology, increased government support, implementing policies that are specifically targeted at the growth of this sector, increased training for labor in the leather industry. By implementing these solutions, these companies would be encouraged to set up in Nigeria, and also it would encourage domestic leather companies to also set up, as Nigeria would become a more business-friendly environment for leather firms. The impact of this would be on the Nigerian economy would be an increased output, increased quality of goods, increase production as well. It will diversify the Nigerian revenue base away from oil to non-oil commodities and lead Nigeria more on its sustainable growth plan.
All right, thanks, Orofe, for your time on the show. Orofe Bajomo is a research analyst with Financial Derivatives Company. And Egypt's central bank unexpectedly lowered interest rates for the first time since an emergency cut in March as the focus moves from lowering more debt investment to supporting economic growth. The Monetary Policy Committee reduced the deposit rate to 8.75% from 9.25%. The lending rate was decreased by the same amount to 9.75%. The MPC says the cut provides appropriate support to economic activity and is consistent with achieving price stability over the medium term. Analysts say the stimulus is timely for the economy dragged down by disruptions caused by the coronavirus pandemic. The International Monetary Fund expects growth of 2% in 2020 to 2021, the slowest in years, following Egypt's biggest ever outflows between March and May as part of a global sell-off. Outside investors began to return after Egypt secured financing from the IMF. Foreign holdings of local debt jumped to $16.9 billion by the end of August, from $14.1 billion a month earlier. And the government of Uganda has approved new guidelines and conditions for mortgaging government land by investors. The Lands Minister, Betty Kamya, says some of the investors have abused the government's goodwill by mortgaging state land without investing the borrowed money into agreed business projects. According to her, in some instances, investors have changed land title use without notifying the government, and in other instances, land remains unutilized but encumbered, putting it at risk. She noted that investors will be required to submit applications for investment to the relevant government entity, and a memorandum of association, certification of registration, and investment license will be issued by the Uganda Investment Authority. In addition, investors are supposed to present a business plan detailing the project idea and the preliminary architectural layout of the proposed facilities. The minister said the investors will be required to present documentary evidence of financial capacity to use the land and the activity plan highlighting key milestones for the rest of 18 months. And the South African Reserve Bank this week announced that the composite leading business cycle indicator increased further by 2.6% on a month-to-month basis in July 2020. Increases occurred in 8 of the 10 available component time series, while the remaining 2 component time series decreased. The composite coincident in the business cycle indicator increased by 3.7% on a month-on-month basis in June 2020. Our South African correspondent spoke to Lumkile Mondi, a senior lecturer at Wits School of Economics and Finance, and he says these are very good indicators in the South African economy.
The leading indicators they inform us that South Africa is now on a recovery phase. So that means basically that there is potential for further growth going forward, which could be catalyzed by foreign investment and domestic investment for that matter. So those indicators are very promising, but they require the government to do more by really fast-tracking the deregulation in the telecom sector that is spoken about, as well as in the energy sector, to allow more procurement of independent procured production of energy. And I think that will lead to massive foreign investment, as we saw in the round 1, round 2, and round 3 of the South African independent power producing procurement process, where there were massive investment into the domestic economy, over 200 billion rand coming into the economy, coming from outside, creating jobs, but also ensuring that during the lockdown, when Eskom was failing, the renewables could supplement that and ensure that the power outages are not 10 hours, at least about 4 to 5 hours.
And with that, we draw the curtain on today's edition of the program. And of course, for the week, thank you for watching. I'm Chimeze Obi Iwago.